Hello class, and welcome. In our last lesson, we discussed the benefits of offering credit to customers to boost sales. But there's a downside. Unfortunately, not all customers will pay the amounts they owe. These amounts we no longer expect to collect are called uncollectible accounts or sometimes doubtful accounts. So how do we account for this? We can't just wait until a customer defaults. Generally, accepted accounting principles require us to anticipate this. The method we use is the allowance method. Under this method, we must estimate future uncollectible accounts and report those estimates in the current period. We do this by creating a special new contra asset account called Allowance for Uncollectible Accounts. This account reduces our accounts receivable on the balance sheet to its net amount expected to be collected. The process generally involves 3 stages, which we will cover in detail: establishing the allowance, writing off a bad debt, and then, in subsequent years, re-estimating the allowance. Let's start with year 1. Kimsey Medical Supply has $20 million in accounts receivable and, based on industry data, estimates that 30% or $6 million will not be collected. At the end of the year, Kimsey makes an adjusting entry to reflect this estimate. They debit bad debt expense for $6 million and credit allowance for uncollectible accounts for $6 million. This entry records the estimated expense in the current year and establishes our allowance. On the balance sheet, this allowance is subtracted from accounts receivable to show a net accounts receivable of $14 million. It's a common mistake to think this allowance is a liability. It is a contra asset that reduces another asset. Now we're in the next year, 2028. Kimsey receives notice that a specific customer, Bruce Easley, has filed for bankruptcy and his $4,000 account is uncollectible. We now write off this specific account. The journal entry is a debit to allowance for uncollectible accounts for $4,000 and a credit to accounts receivable for $4,000. Now, what is the net effect of this write-off on our financial statements? It's zero. There is no decrease in total assets and no decrease in net income. Why? Because we already recorded the negative effects when we estimated the bad debt expense last year. The write-off simply reduces an asset, accounts receivable, and a contra asset, the allowance, by the same amount. What if Bruce Easley later manages to pay some of his debt? Let's say Kimsey receives $1,000. We handle this with 2 entries. First, we reverse part of the write-off to put the receivable back on the books. We debit accounts receivable for $1,000 and credit allowance for uncollectible accounts for $1,000. Second, we record the cash collection as usual. Debit cash for $1,000 and credit accounts receivable for $1,000. At the end of the second year, 2028, Kimsey must again estimate its uncollectible accounts. A more accurate way to do this than a single percentage is the aging of accounts receivable method. This method applies higher estimated uncollectible percentages to older accounts, because the older an account is, the less likely it is to be collected. As you can see from Kimsey's aging schedule, by applying different percentages to each age category, we arrive at a total estimated uncollectible amount of $7 million. This $7 million is the desired ending balance in our allowance account. The allowance account started the year with a $6 million balance. During the year, we wrote off $4 million in bad debts, leaving a current balance of $2 million before adjustment. To get from our current balance of $2 million to our desired ending balance of $7 million, we need an adjustment of $5 million. This amount is our bad debt expense for 2028. The entry is a debit to bad debt expense for $5 million and a credit to allowance for uncollectible accounts for $5 million. To summarize, the allowance method is a dynamic process. We begin by estimating our bad debts and recording an expense. We then write off specific accounts against our allowance as they go bad. And at the end of each subsequent year, we re-evaluate our receivables and adjust the allowance to its new desired balance, with the amount of the adjustment becoming that year's bad debt expense. This ensures our financial statements always present a realistic picture of both our expenses and the net value of our receivables.